Hello everyone, welcome to Liquidity Part 3, I believe, Part 3. So this will probably be the last part of liquidity. I just wanted to talk about, so I was mentioning before about the prominent highs and lows and how that liquidity is can be used as more confluence than just like a normal wick type of liquidity. Instead of just picking a random high or low, there are points in the market where liquidity is, I want to say, better quality. It's better to take a trade off of. But how do we know what these highs and lows are? So just a quick example before we talk about the time aspects of things. We can say in this picture here, in this chart here, where do you think the most prominent high and the most prominent low is? In this chart here. Well, sell side would be here. So that is known as, and buy side be up here. These are known as our external liquidity because it's basically the bottom of a range and top of a range. Buy side liquidity up here, sell side down here. So these are most prominent highs and lows in this current range. So what's going to hold the most liquidity? Is it going to be this low here? No, it's going to be this low here. Is it going to be any of these highs in here? No, it's going to be this high up here. Because these are the most prominent highs and lows in this current range. It is the external liquidity here. So these are going to hold more power. So liquidity sweep after this is more likely to reverse and come down than a liquidity sweep up here. There's basically going to be more sell stops above here. No, more buy stops above here, sorry, and more sell stops below here than there is down here or in any of this buy side liquidity here. So using prominent highs and lows can also make our trading easier because instead of taking a trade based off every single liquidity sweep, we can instead just wait for a prominent high to get taken or a prominent low to get taken, and that trade is going to be much more confluent. It's going to have much more confluence than a trade of just taking off a random point of liquidity. And now talking about random points of liquidity, we can also use the previous day's high and low as liquidity. The previous day's high and low as liquidity. So let's jump on the daily time frame. So this, I'm pretty sure, this is yesterday, I think. So this is the daily time frame. The daily's high is up here. So we want to mark out the previous day's high, and that's our buy side liquidity, and the previous day's low, which is sell side liquidity. And then let's jump back down to the 15-minute time frame. Actually, let's play today's price action. Okay, cool. So what have we done? So this is that previous day's high on the 15-minute time frame now, and we have taken that high. We've swept it. We've swept the high. And why does previous day's liquidity play an important role? Because the high and low of a previous day is going to hold a lot of liquidity under it and above it. That is because it's had an entire day's worth of price action traded within that, meaning there's going to be lots of stop losses on both sides of the market, meaning there's lots of liquidity. So the next day, what's likely to happen is that price will take out either the previous day's high or the previous day's low, and then it will draw to the opposite side. So in this day's example, we have just taken out the daily high, the previous day's high. So now what's likely to happen? We draw down to the previous day's low. And then in the next day, let's say that the previous day's low gets taken, and then we can expect the previous day's high to then get drawn towards next. So that's why it's useful to know and mark out your previous day's highs and lows, because you can use this. You can have an entire strategy based on the previous day's high and low. all you have to do is wait for one to get swept, wait for a previous day's high to get swept, wait for some sort of reversal, like we will learn about in the next videos. We'll learn about fair value gaps, order blocks, market structure shifts, wait for some sort of reversal, enter a trade and target the opposing side. So this is just taking out the previous day's high, so we can target the previous day's low. And we can also use session highs and lows. So as you know from the beginners PDF, I've spoken about how trading is split up into different sessions. So this is GBP USD, so this is Forex trading because it's a currency pair. And the Forex day, so it's a 24-hour mark, it's 25/5, so it's 5 days a week, 24 hours a day, closed on the weekends. I'm going to change this to London time because that's where I know it of. Okay, so the Forex open times are slightly different to the New York Stock Exchange times. So for Forex, we are looking for, so midnight is when Asia session opens. So let's mark that out. Midnight, UK time midnight. New London session is next, which opens at 8 AM London time. And then New York session opens up at 1 o'clock UK time. So these are sessions per day. Now, each session's high and low acts just like the previous day's high does. It can be used to take trades off of. So we have Asia session, bang, 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 bang. Here's the low of Asia. So we mark that out as our sell side liquidity. Oops. And then we also have Asia's high. Asia's session's high, which is our buy side liquidity. And then London session opens. We retrace a little bit, we come up, and what do? We take out Asia's high. And then we start coming down. And we can draw towards Asia's low, which is quite far away, so we might not reach that just yet. But it doesn't matter because we've taken out Asia's high now, and look, we started to reverse. And we could have easily found a trade within this. So yeah, the market structure shift here. Don't panic if you don't know what that is. We will learn all about it. And you can simply target sell side liquidity. That would be a nice winning trade. 1 to 5, 1 to 1.5, sorry. Just by using previous session's liquidity. So we take out Asia's high and we come down. And now, oh, here's another example, just noticed. So that was Asia's high and low. We can get rid of that now because and then now let's focus on London session. London session's high is up here. That can be our buy side liquidity. London's low is this low here. That's our sell side liquidity. So we have London's low, which is sell side liquidity because it's the low. And then look, New York session opens and we took out London's low. We took out London's low and now we are reversing back up. And where may we be going? Towards London's high, up here. Quite a way to go yet, but we could have easily found a trade again in this. We had break of structure here. Could have simply entered on that with Liquidity Series break structure. Target this high as one of our targets, and next up target London's high, which hasn't quite reached yet. So you see how we can take trades based off liquidity, as in previous day's high and lows, and also previous session highs and lows. Because these all act as great liquidity. because with session highs and lows, because think about it, so let's go back to Asia session. Get rid of these. Asia session in here, okay? So think about what the banks in London want to do. What do they want to do when they open up? They want to take out all of the traders that were in Asia session. And how do they do that? By taking their stop losses, by taking either the high or low. Here, they took the high. London, the market movers in London took out Asia's traders by taking out the high and wiping out stop losses for sellers. Same thing in New York. When New York opened, what do they want to do? They want to take out the traders in London. So how do they do that? By taking out the previous session's high or low. And they've just done this now. So do you see how by using the previous sessions, we can start to form trades based off liquidity sweeps? Because these are all liquidity sweeps. When a price takes out a session high or low, it's a liquidity sweep. So now we sort of learn how, by instead of taking a random trade based on this random buy-side liquidity, it's still buy-side liquidity here, this wick here. However, there's no sort of reasoning behind why we're using this particular high. However, if we begin to use session highs and lows, there's a reason why we take a trade based upon that, because it is the previous session which is stacked with liquidity ready to get taken out. The same with the previous days high and low. You're not just taking it off a random candle, you're taking it off a previous day, meaning there's a reason why you're waiting for either a high or the low to get taken. Do you see how liquidity starts playing a role now when you base it off sessions and previous days high and low, and not just take a random liquidity sweep off, I don't know, this high here, for example, this high here, this liquidity sweep? Yeah, it's a liquidity sweep, but it's just a random candle. It's not any session high or low or anything. So I'd rather be taking a trade based off when we swipe a high or low, either from a previous session or a previous day, or you can do it a previous week or previous month or previous 4-hour candle. Just try to mark out your liquidity that has importance behind it. A random wick on the 5-minute time frame, like this low here, yeah, it has importance behind it. Yes, it has liquidity under it. However, it's not going to be as prominent as a previous session or previous day's high and low. So just bear that in mind when you're looking for liquidity sweeps. You ideally want to have a liquidity sweep that has importance behind it. So it's either a session high or low, previous day's high and low, weekly high and low, previous 4-hour candles high and low. Anything on these high time frames really are really important. And that liquidity holds a lot more importance than a random 5-minute liquidity sweep, for example. But we also, what was I going to say? There's something else I wanted to bring up with liquidity. So we know about using previous sessions now. So on the charts yourself, I'd recommend going out and marking out the previous sessions using the same times that I did a few minutes back. And just going over the chart, I'm looking at when price takes out either high or low and what happens after that. Does price reverse and take out, if it takes out a high, does it reverse and then go and take out a low, or vice versa? Just look out for things like that, because that's a lot more important, like I've said a few times now, than just a random low or a random high. So yeah, in my own trade, then I'm looking for these prominent highs and lows to get taken, and ideally not just a random high or low. Because in the past, I have just taken trades based off random highs and lows, which obviously they do have liquidity behind it, but they're not as significant as a previous session or a previous day. So just don't get too caught up on that. And always remember that these higher time frames liquidity hold a lot more power than these lower time frame liquidity. And also, so going back to the previous day's high and low, so in that example we had marked up, we have a high buy side liquidity, let me mark that. Then we also have our low, which is sell side. And what is the current trend on the daily time frame? Bearish. We're bearish. So ideally, coming into this day, we want to be looking for shorts. So if we're looking for shorts, then we want to ideally be trading towards this sell side liquidity. So what we want to look for, what would be great is if we can take out the previous day's high. If we can take that out, and I just said that we're in a bearish trend, so I want price to come up a little bit, take out the previous day's high, and then we get a reversal so that we can short down towards the previous day's low, because that is going to be the move of the day, because on the high time frames we're bearish, meaning I want to see buy side liquidity get taken out, and then I can enter a short position somewhere in here if my other confluences line up and trade it down towards sell side liquidity. I don't want to be looking for longs in here because look how bearish we are, but instead I want to see a slight retracement up to take out the high and then take a short position down to sell side liquidity because my bias is bearish because we are trending downwards. So if we're trending downwards, I want to see some sort of buy side liquidity get taken. In this instance, the previous day's high get taken, and then we look for a short, and so we reverse back down to sell side liquidity because we're bearish for the day, so I want to be looking for a short. I wouldn't be shorting this close to it because a perfect short would be up here, because what have we just taken out? Previous day's high, which has buy stops above it, and they've just been taken out. So what's ideally going to happen next? The market sells off, which it's done. It sells off down to here. So yeah, if you're bearish, you want to be looking for highs to get swept and take trades towards the lows. If you're bullish, then you want to be looking for lows to get taken and then trade up to the highs. So you wait for a slight reversal. So we're clearly bearish here. We're waiting for a slight reversal, which was here, and this was just to take out the previous day's high. We're only reversing so we can take out the previous day's high. This doesn't make us bullish. Doesn't make us bullish because all we've done is take out the previous day's high. And then you wait for the actual move, which is to carry on going downwards, because chances are we will carry on with this trend. So if you are bearish, you are looking for buy side liquidity to get swept and then trade towards sell side liquidity. If you are bullish on the day, if you've got a bullish bias, if we're in an uptrend, then you're looking for sell side liquidity to get taken, and then you're taking a trade up to buy side liquidity to carry on with the bullish trend. In this instance, we're obviously bearish, so we're looking for the high to get swept and trade towards the low. So I hope that sort of brings everything together for liquidity, and it shows you how important using previous days highs are, using previous sessions highs and lows are. But yeah, I hope that all makes sense. If it doesn't, drop any questions in the chat and I'll get back to you, and I can easily make another video for you guys to clear anything up. Cheers guys.